Hey, Tori. So I'm having some questions for you, especially from clients about obviously people are very focused on the rates because they're very low before. Now they're raising. Then people see things on the news about rates jumping, and sometimes we aren't clarified by our sources, whether it's news or other people, which rate they are talking about, which can be the mortgage rate, which is tied to the bond market, and also the prime rate, which is tied to car loans and any type of other credit cards, interest rates pertaining to loans. So can you please give us a little clarification on your experience since you've been in the industry well over 25, 27 years and have seen the rates go up and down and followed the market. So can you please give us a little bit of your input for clarification?
Yeah, sure, Nick. So yeah, a lot of people, this is the misconception that's out there, right? A lot of talk in the news right now was a few weeks ago too about the prime rate. Hey, the Fed is meeting and they're going to raise rates, or the Fed just met and they didn't raise rates recently, or the Fed's going to meet and maybe they're going to raise and maybe they're going to lower. And a lot of people think that means that it directly relates to the mortgage rates. If the Feds raise mortgage rates, they go up. If the Feds lower mortgage rates, they go down. And that's where the misconception is. So the Federal Reserve rate, it's the money at which banks, excuse me, trade money with each other, basically. But that's the Fed moving the interest rate at which banks borrow money from the Fed so they can loan it to us. And that's called the prime rate. The prime rate is not tagged to mortgages, to 30-year fixed mortgages, which is what most people think. The prime rate is tagged to lines of credit, though. So if you have a line of credit on your house and they say the prime rate is going up a quarter, that afternoon your rate went up a quarter. If they say the prime rate is going down a quarter, that means that afternoon your rate went down a quarter. Those are tagged directly to the prime rate, home equity lines. Credit cards are tagged to prime, some car loans are tagged to prime, but they are not tagged to 30-year fixed mortgage rates. Picture this a totally separate thing. 30-year fixed mortgage rates are tagged to the 10-year treasury bond called the yield on the treasury bond. So view it like if it was tagged to Apple stock, right? If a 30-year fixed mortgage was tagged to Apple stock and you said if Apple stock got greater, the mortgage went greater. If Apple stock went down, the mortgage went down. So the mortgages, 30-year fixed mortgages are tagged to what's called the yield on the 10-year treasury bond. So if you want to know what mortgage rates are doing up or down, you look online and say, what's the 10-year treasury bond doing? So remember, there are stocks and bonds, right? People want to put their money into the stock market. They buy Apple, they buy Google, they buy things like this. When people want to be very safe with their money, they put their money in US government bonds because that's safe, because the government always pays back, because the US government is the greatest entity that you can guarantee that if you invest money with them, they're going to pay you back, right? Which is why when like the people were talking about the US government a while back, maybe defaulting on their loans, when that whole thing was going on a few weeks back, that gives people in the marketplace the news like there's instability with the United States economy. And holy cow, what if they won't pay on it? And that bad news, like don't invest money in bonds because the government may default. That made mortgages be less sought after, right? That made bonds be less sought after. So it made them more expensive and the rates went up. Now, when the US government's doing really great, everyone has tons of confidence and everyone's pouring tons of money into the bond market, it brings the yield on the bond down and makes it less expensive. And so that's why when you hear bad things about the United States economy, maybe the rates will move as a result of that. But they are tagged directly to the 10-year treasury note, the 10-year treasury bond, basically.
Then also the prime rate, the reason why they increase those rates is to hedge inflation, to lower the rate of inflation. And reading articles, they actually, how the government regulates inflation is they look not where the market is or will be, they look at what it prior was doing is where they pull their numbers at with the inflation. Is that correct? Or can you explain a little more?
Yeah. And again, not to get too deep in the weeds, economics 460 or anything, but when the United States is trying to slow down the economy, like too many people are spending, they're getting out of control, they start raising the rates on stuff. They want to make it harder, right? Like when the rates were 3%, we all went out and got lines of credit. Like when the prime rate was 3%, people were putting lines of credit on their house, buying cars, buying boats, buying second homes. They were spending like crazy. So as they push that prime rate up now into whatever 6, 7, 8, wherever they push it, that then changes people's mind. Maybe I won't put an equity line at my house and go buy a car, a boat, a house. So they're trying to slow down spending, right? So that's basically a very sophomoric view of just when the economy is getting so out of control and people are just spending and not caring, the government's trying to make things more expensive. So people slow down and they're like, wait a minute, this is too expensive. That's inflation making things too expensive too fast because people will pay for it. So the government's trying to temper the spending, which will hopefully help. And this is, again, a very sophomoric view of it. There's a lot more that goes into it, but the basic nuts and bolts. How do we slow down the spending to bring inflation down, to bring prices down so everything gets back to normal? Good interest rates, good, and right now the economy is going crazy. The prime rate is now higher than the 30-year fixed rate. I mean, so your line of credit is higher. You think a 30-year fixed mortgage is high. Not really. It's pretty usual and customary over the history of where it's been. But the prime rate is super high right now because they're just trying everything. So it was a big move not to raise prime last time. That was like the greatest news. The greatest news would be to lower it. But the fact that we were going up on the prime rate and it was always going up, people kind of go freak out there and say, oh, the prime rate's going up. That means all rates are going up. I shouldn't buy a house. Not true. Just the news that they didn't put up the prime rate the other day, a week or so back, just that news that they didn't put it up and they may not put it up next time, just that news boded very well in the bond market and the rates that they actually ticked down a little bit. Mortgage rates actually ticked down as a result of that news the other day. So I think the big thing your clients and you keep asking, we want to let everyone know is when you hear the Federal Reserve rate or the prime rate and whether it's going up or down, that does not mean the 30-year fixed mortgage is moving with that news or with that rate. There's no direct correlation moving that. They're both based on a lot of economic factors, and it's possible they could move together, but they're not tandem. They're not tied together. When one moves, the other doesn't move necessarily in the exact same direction. And that's the thing we want everyone to pretty much understand is just the gist of what you hear and what's true.
Yeah, and I think that, being a consumer, whether you're going to be buying or selling, obviously you hear these things and, rates are involved, especially when buying. I think it's important to be aware of this knowledge. And also when you hear things, do research. And so you do know whatever source you're listening to, what they're talking about makes sense to you. So I just think having this knowledge is very important. If anybody has any questions, feel free to reach out, and hope you guys enjoyed the video. Thank you.
Thank you.